PSA week 42, day 5, bench press 295 times 4.
Said something like, unlike Coca-Cola. Boyzueta thought I was an uppity, arrogant kid who was painting some kind of picture that I was engaged in some masterful act on a daily basis, whereas anybody could leave at noon and go golfing if they ran Coca-Cola. And Roberto hated Bill from that point forward. Buffett avoided technology stocks partly because these fast-moving businesses could never be run by a ham sandwich. He thought it no shame to have a business that could be run by a ham sandwich. He wanted to get Berkshire Hathaway to the point that it could be run by a ham sandwich too, though not until after he was gone. But by 1997, Coca-Cola had started to set goals for itself that were so ambitious that it took not a ham sandwich, not even Boyzueta, but a lot of financial engineering to achieve them. Coke owned 40% of CCE and tended to act as though it owned 100%. The creation of CCE by rolling up a group of bottlers had been part of a larger strategy of buying and selling bottlers in order to time the profits and boost Coca-Cola's earnings. This was neither illegal nor technically deceitful, but it was nonetheless an illusion, and Warren, who was on the board of Coke, was always aware of the potential for misrepresentation. Roberto did a lot of things operationally that were terrific, and I liked them. But Roberto got tangled up in promising numbers that eventually couldn't be delivered. He talked about high teens growth, 18%. Big companies are not going to increase their earnings in the high teens over long periods of time. For a while you can do it, but it just isn't in the cards to keep it up forever. I remember when he came in and talked to us about how he was going to add a third leg to earnings, which was profits made on buying and selling bottlers. He tried to sell the finance committee that this was the way of the future. The prices they paid for bottling companies were just nuts. I asked the chief financial officer all these questions, but Roberto started the board meetings at 10 o'clock and finished at noon. The atmosphere was such that it didn't lend itself to questioning. He just had a feeling when it got to be noon that it would not be at all polite to keep raising subjects or talking about things that would cause the meeting to last until 1 o'clock. He was just not a guy you questioned. Some people have that bearing about them, and when the bearing is backed up by a very good record, the combination of the two is pretty overpowering. Buffett was more than simply non-confrontational. He was of an age and from an era that viewed serving on boards as a quasi-social activity in which deference and politeness held sway. In 1998, that was the boardroom culture throughout America. This culture reflected the reality that the structure of corporate boards gave directors very little leeway with management. As a director, you can't remotely tell management what to do. All this stuff you read in the press about the board's setting strategy is baloney. As a board member, you can do practically nothing. If the CEO thinks a director is smart and on his side, he'll listen to some degree. But 98% of the time, he'll do what he wants to anyway. Listen, that's the way I run Berkshire. I think Roberto liked me, but he was not looking for a lot of ideas from me. Buffett never knew of anything seriously enough awry at Coca-Cola to make him consider the drastic step of resigning from the board. Howie had a different problem, standing up to pressure from Coca-Cola. I was more independent than just about anybody else on that board, because I was on the Berkshire board, and no one at Coca-Cola could intimidate me, says Howie. So I had no problem challenging Coca-Cola on behalf of CCE. But Howie eventually got off the CCE board. There was just too much potential for conflict between the two boards. In the sense that people learn more from heavy seas than smooth sailing, if Keogh had meant to send Howie to another crash course in business school, the CCE role was a success. Howie's radar for danger signs in business had sharpened considerably. Even though he continued to serve on boards, the experience taught him that he wanted to fulfill his thirst for excitement outside the corporate world. By the mid-1990s, Boyzueta and his financial chief, Doug Idester, were dosing Coke with even larger amounts of bottle profits to maintain the illusion of the company's rapid earnings flow. Then, in 1997, Boyzueta died unexpectedly, only a few months after announcing he had lung cancer. The board and the company, he had been a statesman-like CEO, credited with making Coca-Cola an international giant. His persona so titanic that it was hard to imagine who could fill his shoes. The board had deferred to Boyzueta so absolutely that nobody ever seemed to have thought of any alternative to his handsome successor, the burly, cable-pounding Idester. The finance chief had a big reputation. He had engineered much of the company's recent success, carving up the financial interests of Coca-Cola and its bottlers to squeeze out every last advantage in Coca-Cola's favor. Boisweta was the aristocratic leader, Ivester the hands-on doer. He loved technology and hummed along with the Silicon Valley gestalt of the times. Buffett liked Ivester and wanted him to succeed. A textile factory mechanic's son who had risen through sheer determination, Ivester was an analytical numbers guy. And of course, under Boisweta, he had enriched Buffett enormously. He had that underdog grit that Buffett liked. Moreover, Buffett laid responsibility for the accounting typically at Boisweta's door, not Ivester's. Juicing the earnings had certainly worked. Coca-Cola was trading at $70 per share. BRK itself was rocking the market. Priced at $48,000 in June 1997, it flew to $67,000 over the next 9 months. The higher the market went, the tougher it got for Buffett to invest, and yet the higher BRK rose. It made no sense, except that the stocks that Berkshire owned were rising with the market. As 1998 progressed, the Dow crossed 9,000 and was on its way to the magic 10,000. BRK blasted through $70,000 a share. At the shareholder meeting, Buffett told investors, "Our idea of tough times is periods like now." With too much cash, too few wonderful ideas, and without calling the Airaholic hotline, Buffett now bought a company for Berkshire called NetJets for $725 million. He sold the indefensible and became one of NetJets' customers. This company sold timeshares in jets of various makes and sizes. Its planes all had tail numbers that started with QS, or Quebec Seattle. Susie got warranted by her a quarter share in a fractional jet from NetJets in 1995, worth 200 hours a year of flight time, which she referred to as the richly deserved. She joked that QS stood for Queen Susie. Buffett took to NetJets so much that he had appeared in an ad and endorsed it even before he bought it. Still, on the surface, it was an atypical decision for a man who would, 1 year later, tell the moguls at Sun Valley that somebody should have shot Orville down. The reasoning behind the purchase seemed sound, though. NetJets was dominant in its market. It was too late for any serious competitor to catch up. Buffett figured that it was not unlike the newspaper business, where there were no red ribbons. Eventually, the competitors would fall away. And indeed, NetJets was outgrowing the competition. Buffett was intrigued with its CEO, Richard Santulli, an entrepreneurial mathematician who had formerly spent his days at Goldman Sachs figuring out trading patterns using chaos theory mathematics. Now he used those same skills to schedule plane flights on 6 hours' notice for a database full of celebrity clients whom he entertained at private events. Buffett met a whole new set of famous people, including Arnold Schwarzenegger and Tiger Woods. Investors cheered Buffett's purchase of NetJets, but were shocked when he almost simultaneously announced that Berkshire was buying General Re, a huge insurance wholesaler, or reinsurer, which bought excess risk from other insurers. At $22 billion, this deal was almost 30 times larger than NetJets. It dwarfed by multiples his largest deal ever, Geico. When he met with the Gen Re management team, Buffett told them, "I'm strictly hands-off. You guys run your own business. I won't interfere." Then he suddenly started spouting numbers from Geico. Well, you know, their hit ratio has dropped a bit. The hit ratio is the percentage of phone calls coming into Geico that turn into sales. Last week, their numbers were, "Holy cow," thought Tad Montross, General Re's chief underwriter. "This is hands-off? He knows more about Geico than we know about General Re." Buffett did not know much about the inner workings of General Re. He had made the decision to buy based on studying the company's results, and he liked its reputation. General Re was sort of the Grace Kelly of the sometimes shady insurance business. General Re wore white gloves and historically had acted more ladylike and respectable than the average company. Still, given the pattern of Buffett's purchases of insurers, in almost every case, and given the size of this deal, the distant rumble of the tow truck's engine warning up could be heard, barely audible, over the next hill. But it was the high price paid for General Re that attracted most of the attention, and the fact that Buffett had paid in stock, not cash, in effect swapping 20% of Berkshire Hathaway for General Re in a deal announced on the day that Berkshire hit its then all-time high of $80,900 per share. People wondered if Buffett's willingness to give away his stock when it was trading at such an unheard-of price meant that he too thought BRK was overvalued. Buffett had spent his career tightening his stranglehold on Berkshire. Giving stock to General Re's shareholders diluted his own personal voting interest in Berkshire from 43% to less than 38%. The last time he had paid stock for a major purchase, it was Geico, and investors had believed then that Berkshire was overpriced. So they speculated about the message Buffett's new deal might be sending. The price of BRK swung up and down based partly on the prices of the stocks that Berkshire owned. It was especially high at that moment because Berkshire owned 200 million shares of Coca-Cola, which now traded at an astronomical price. So if Buffett was subtly signaling through his purchase of General Re that BRK was overvalued, did that mean that its underlying stocks, like Coca-Cola, were overpriced? If so, this could have implications for the entire market. It might mean the whole market was overpriced. The king of the soft drink world, Coca-Cola ruled with an aggressive swagger, a fizzy, dizzy arrogance. Buffett's stake in KO had multiplied 14-fold over a decade to $13 billion, and he had gone so far as to declare the company inedible to his shareholders, as if it were a stock he would never sell. He reasoned that Coca-Cola would send more swallows down more throats in each passing decade for an investing lifetime, which made it about as close to immortal for a brand as you could get. Berkshire now owned more than 8% of the company. Coca-Cola stock was trading as high as 40 times its estimated 2000 earnings, a multiple that said investors believed the stock would keep rising by at least 20% a year. But to do that, it would have to increase earnings 25% a year for 5 years. Impossible. it would have to almost triple sales to a number nearly as large as the entire soft drink market in 1999. Again, impossible. No amount of bottler sales or accounting finables could produce results like that. Buffett knew it. Nevertheless, he did not sell his Coca-Cola stock. The reason was partly inertia. Buffett liked to say he made most of his money by sitting on his ass. Like the investors had kept their Geico stock when it fell to $2 a share, inertia had protected him from many mistakes, both of commission and of omission. He also owned too much Coke to sell without creating a major headache. The symbolism of Warren Buffett, the world's greatest investor and a board member, dumping Coca-Cola stock would be unmistakable. The price of Coca-Cola could plunge as a result. Besides, with its effervescent mix of profit, product, nostalgia, show business, and likable people, Coca-Cola was Buffett's favorite stock. The real thing wasn't a slogan to him. It was an incredible cash machine that could grind out money forever, like the mill in the old fairy tale that endlessly ground out rivers of porridge, mountains of gold, or an ocean's worth of salt. Buffett carefully sidestepped these questions about the market in Coca-Cola when he used Berkshire stock to buy General Reed, saying, "It is not a market call whatsoever." BRK, he said, was fairly valued before the merger, and the combined companies would create synergy. When Charlie Munger was asked, he stated that Buffett had consulted him about this deal very late in the game. In effect, he disowned the deal. Not unexpectedly, investors began to reprice BRK as if either Berkshire and its holdings in stocks like Coca-Cola were overpriced, or the deal's synergies would prove elusive, or both. Buffett's explanation later that summer at Sun Valley was that we wanted to buy Gen Re, but coming with Gen Re was $22 billion of investments. Many were stocks. Buffett promptly sold them. Adding $22 billion of bonds changed the bond-stock ratio of Berkshire, which I was not unhappy with. It did have the effect of a portfolio allocation change. So Buffett, who signed the Coca-Cola board with Herbert Allen, was not unhappy with swapping BRK stocks, including Coca-Cola, in an ocean of General Re's bonds. This statement in context made all kinds of sense. In his previous shareholder letter, Buffett had written that stocks were not overvalued if interest rates stayed below average, and if businesses kept delivering extraordinary returns on capital. In other words, if the unlikely continued to occur. This statement was oblique enough to avoid looking like a forecast. Buffett thought those who were always out prophesying some turn in the market's direction usually wound up being wrong 10 times out of 2, so he rarely made statements about the market, and often played coy when he did. Still, it was unusually clever of him to work the words "not overvalued" into a sentence that said that the market was overvalued. People could read this message any way they wanted, but if they were smart, they got it. Likewise, Buffett was not unhappy with diluting his stock portfolio in the same Sun Valley speech when he faced an audience filled with internet CEOs at a time when internet stocks were parthenogizing faster than naked mole rats. He accompanied his not unhappy with remark with the same warnings as in his letter, that interest rates must stay well below average and the economy stay unusually hot for the market to meet investors' expectations. This was also the same Sun Valley speech where Buffett had used his place in the pulpit to explain that investing is laying out money today to get money back tomorrow, like Aesop's bird in the hand versus the birds in the bush. That interest rates are the